Hey Samfam, this is Shia from SAMAYA, and today we are going to discuss about SA 210, agreeing the terms of the audit. Who has to agree? The management and the auditor. Why they have to agree? Because they are the auditor and auditee who are agreeing to the terms of the engagement or that engagement letter. The engagement letters contains few terms and we'll discuss about that. And first we'll see the objective of the auditor, the objective of SA 210, what the auditor wants to achieve. He has to know whether to accept or continue the audit engagement on basis whether upon which it is to be performed, there has been agreed through establishing whether preconditions of an audit are present. In order to take a decision, the auditor need to take a decision whether to accept or continue the audit engagement, he has to know that there were preconditions of audit and confirming that there's a common understanding between the auditor and management, and where appropriate, TCWG of the terms of engagement. What they have to have a common understanding. You see, our audit engagement is mostly like an agreement to do a particular job. That is engagement. So both the parties who is giving that work, like the auditee and that's the entity, and the auditor who has to perform that engagement, both mutually has to agree to the contents or the terms of that audit engagement. So what should be exist? Preconditions and a common understanding of the auditee and auditor. This is what the objective of the auditor is with regards to. So if there exists preconditions of the audit and a common understanding, he could accept or continue the audit engagement. Accept or continue. Accept is for the initial audit engagement. Continue is previously has been an auditor and without to continue this year, he has to move. That is, he has to check for the preconditions of the audit and common understanding every year. That's the key point there. And now we'll see what are the preconditions of an audit. Financial reporting framework to be applied in preparation of financial statement shall be acceptable. That is, the responsibility of the management is to prepare the financial statements with regards to the financial reporting framework. That financial reporting framework should be acceptable. When that financial reporting framework is not acceptable, then what it has to do, what the management has to do, and what the auditor has to do. First of all, that entity is not having an acceptable financial reporting framework. The management does not have an appropriate basis for preparation of financial statements. That's a consequence. Yeah. If apart from this financial reporting framework, they do not have any other option to do and to prepare the financial reporting framework. And the auditor also does not have a suitable criteria for auditing the financial statement. That is, except that financial reporting framework, which is not acceptable, they do not find a way, or they cannot figure out how to prepare financial statement. Then the auditor has to presume that the applicable financial reporting framework, whether that is acceptable or not, is acceptable. And that is like a compromise situation for the precondition of the audit, for the first precondition. And the second thing is the management to provide the auditor with access to all information of which management is aware that is relevant to the preparation of financial statements, such as records, documentation, other matters. Have you heard this before? This is the premise. This is what the responsibilities of the management is. We'll often write this in all the auditing standards and all. Even in SA 200, you could find out. And such additional information that is the auditor may request from management for the purpose of the audit. They have to give all the relevant information. First thing, they have to give all the additional information. Why they have to give all the additional information? What they're talking about? They're talking about the written representation, the third party balance confirmations. They're talking about that. And unrestricted access to persons within the entity from whom the auditor determines it's necessary to obtain audit evidence. And tell that's like observing the internal controls or investigating or talking to the in-house legal person, etc. This is the premise of responsibility of the management or duty of the management while starting the audit. Management acknowledges and understands its responsibility. Okay, relax. What's the responsibility of management? We have been talking a lot since past few videos. What's the responsibilities of management? There were mainly two responsibilities. First thing is they have to prepare the financial statements. Second thing is they have to design, implement, and monitor the internal control systems for a correct preparation or proper preparation of financial statements. Now we'll see what they're talking about. Preparation of financial statements in accordance with applicable financial reporting framework. Okay, they're talking about the preparation of financial statements and internal control to enable preparation of financial statements that are free from material misstatement, whether due to fraud or error. They have to design, implement, and monitor the internal control system to enable the preparation of financial statement. What that internal control system's objective is? Their objective revolves around the preparation of financial statements. The management revolves around responsibility revolves around the preparation of financial statements, and the auditor is to form an opinion on that financial statements. Okay, if you know the objective of the parties individually, you could easily write or you could easily retract the topics what all you have learned past year. Yeah, and these were the prerequisites, preconditions of an audit. What are they? They need to have a financial reporting framework which is acceptable. If it is not acceptable and they do not find any other way to prepare the appropriate basis to prepare the financial statements for the management, and the auditor also did not find any kind of way to audit, what the auditor has to do, he has to compromise and think that the applicable financial reporting framework is acceptable. That's it. Second thing is the premise, all information, additional information, and unrestricted access. Third thing is the management responsibility. That's preparation of financial statements and internal controls. And the audit engagement letter contains what all the engagement letter should contain. These were the terms of the engagement. Okay, relax. We'll see. While entering into the any kind of agreement, what the parties should have a minimum thing about. Forget whether it's an audit engagement or anything. If you got a job or you have a task and the client of you was asking, or you and your client were doing an agreement, what all the things live in the situation. First, you have to know the responsibility of you and your client both. Second thing, what type of work has to be done, and till what extent the time has to be done, or till what extent the task has to be done or the job has to be done, and whether how the output should be. How the output should be. You have to talk about the process, how it should be, and you have to talk about how the output should be. And again, like remuneration and time, legal matters, and all has to be included. Now, coming to the audit engagement letter, what shall it consist of? Live in the situation as an auditor. What you need to have? You need to have the responsibilities of the management, that is your client, and responsibilities of the auditor, that is you. Second thing, what you have to do, the objective and scope of the audit of financial statements. Till what extent you have to do? What's the objective and scope of the audit? And identification of applicable financial reporting framework for the preparation of financial statements. That is what the preconditions of the audit are. Reference to the expected form, that is how you wanted your output be. And content of any reports to be issued. You see, the reports that were expected from a bank but not same to be expected from an electricity company or a hospital, right? Hospital industry. So what kind of form or what kind of reports you wanted? Okay, responsibilities of both the client and how till what extent you have to be done, and the precondition, that is financial reporting framework. And second, and the last thing is about the output, what type of output you're having. And if you live in that situation, it is very easy. Remembering through mnemonics is a hectic task, and in the exam tension or under pressure, it's a high chance that you write answers of one to the another. Change in the terms of the engagement. Auditor shall not agree to the change in the terms of the audit engagement where there is no reasonable justification for doing so. We have discussed this in our keyword kit, right? With regarding to any kind of, I think I didn't remember the number. Please do check it out. It's between 1, 2, 3. And with regards to change in terms of engagement, what the auditor should do, he has to not agree, and there was no reasonable justification is given. First thing, and if that changes conveys a lower level of assurance, the auditor shall determine whether there is a reasonable justification for doing so. What the auditor's objective is? Auditor's objective is to obtain a reasonable assurance or to provide a reasonable assurance. But it's such change in terms of engagement is lowering such assurance, then you should not accept that unless there is a reasonable justification. If terms are changed, the auditor and management shall agree on record the new terms of the engagement in the engagement letter. This is again a second part of the objective. It's like agreeing to the common understanding, right? Whenever there is change, both the parties have to mutually accept. First thing, he has to not agree whether if it's not having a reasonable justification. If it's lowering the assurance, he could accept with if it had a reasonable justification. And if the auditor is unable to agree to change of terms and is not permitted by management to continue the original audit engagement, that is implementing a restriction on the scope of the audit, then what the auditor shall do? First we have to withdraw from the engagement where possible under applicable law and regulation, and determine whether there is an obligation to report to circumstances and to other parties such as PCWG owners or regulators. You not only write these two. First, how if there was exist any kind of limitation on scope by management, how the answer should be is that first he has to communicate to the management and ask for reasons. That's what they're talking about here. They're asking about the reasons, and if it's reasonable, you could perform alternate audit procedures and obtain sufficient and appropriate audit evidence, and that's fine. And if you cannot obtain sufficient and audit evidence, that is lower level of assurance, what you have to do is that you have to communicate with higher authorities, that is TCWG, etc. And if they were also not giving it, and you're not satisfied with that reply, what you have to do, you have to find out whether you have to communicate with any kind of regulators, like if you have found a fraud, and whether there exists some regulations, right? You have to communicate with them, and then withdraw from the engagement. This is what's the process flow of that. Audit is mostly like a behavioral science, and if you live in that situation, it is very easy. So we have seen this portion, right? And there were two portions here, and we are coming to the end of this topic. Factors for determination of acceptability of the financial reporting framework. We have been previously discussed about that when the financial reporting framework is not acceptable, the applicable FRF is not acceptable. On what categories we could judge whether that FRF is not acceptable? Because by the nature of the entity, in which industry or in what kind of industry it is in, the nature of financial statements both has to align. The nature of the entity and the nature of the financial statement has to be aligned. And the purpose of the financial statements also has to be aligned, whether they were CFAs or whether it's from standalone or interim financial statement. The purpose has to be also aligned. When these three were not aligned, when the nature of the entity financial statement and the purpose is not aligned, that is not an applicable, acceptable financial report framework. Applicable is different from acceptable. Don't get confused. The applicable should be acceptable. That is when the applicable FRF is acceptable, when its nature of the entity, nature of financial statement, and the purpose of financial statement are all aligned. And the hotel industry could not get aligned with the insurance industry, and insurance to a banking industry, right? All the financial statements were different. And determining the acceptability of general purpose framework, this could be a direct question. And you see, when these all things you could be remembered as a mnemonic, but try to remember from the question itself. You see, you have neutrality here. This was general purpose financial statements, and it goes with NE there. When you find a general purpose framework, try to circle things that were easier to remember. That was easier for the answer. That's more better. So we could be less confused in that stress situation in the examination. About the purpose. Purpose is for the relevance of the information provided in the financial statements. It has to be relevant. Obviously, why they are talking about the relevance and reliability and completeness of the information is sufficient, appropriate audit evidence. It all lies there. Auditor has to obtain sufficient and appropriate audit evidence. Sufficient is with regards to the quantity. Quantity is completeness. So, appropriate is more of relevance and reliability. They have to be more of the relevance category. Reliability is with regards to the more the management is not. If management is not integral, integrity is not maintaining integrity and has doing some frauds and all, that written representation that were given by the management were not reliable, right? That's when neutrality and understandability, understandability. These are the things. What the acceptability of general purpose framework. Relevance in that the information provided in the financial statement, completeness in that transactions, reliability in that information. These three you could easily write: relevance, completeness, reliability, neutrality, and understandability were two new words that you have to add into this concept. And the objective of the author, and that's it for 210. Please do leave a like and share it with your friends so